Earlier today, during my panel here at the World Economic Forum, Bridgewater Associates founder Ray Dalio weighed in on the growth and implications for monetary policy, importantly.
The question really is whether monetary policy is denominated in one's own currency. These are all cycles. The cycle, like in China, I agree, it's one of those cycles people pay attention to, but they have the power, the debt is in their currency, they can handle that cycle. But there is a weakening there. There is a slowing, certainly a substandard growth rate in Europe, and in the United States there will be a significant slowing in that particular period, which should warrant an easier monetary policy.
And he said that he's not expecting the Federal Reserve, and he doesn't think the Federal Reserve should raise interest rates at all in 2019, given the backdrop. Joining me right now is the co-CEO of the Carlyle Group. Glenn Youngkin is with us here. Glenn, it's good to see you again.
Good morning, or I guess good afternoon.
Yeah, good afternoon here in Europe, that's for sure. Look, you own what? Invested in 250 companies. Yeah. You've got $212 billion in assets under management. You've got 70 billion of that already in the ground, companies that you already own already. So tell us what you're seeing from this incredible vantage point from these 250 companies that you own. Are they slowing down?
Yeah, I think global growth is absolutely slowing, but it's not stalling. And I think this is where the market is being a little bit schizophrenic. What we see throughout the globe today is growth, but not at the pace we saw last year. The biggest change, I think, is in China. And in the fourth quarter, and we've seen the data, our company data would suggest that China slowed a little bit even more than what was suggested in the official data in the fourth quarter, although we did see some recovery in December. China is dealing with something very new, which is a consumer-driven slowdown in growth. And one of the great recognitions is that China, which used to be this big export economy, is really driven by this giant consumer class that's been created over the last 20 years. And that consumer class is nervous. They're nervous for all the same reasons that other people in the world are nervous, and that's reflecting itself in the Chinese economy.
I think this is such an important point that you make, because for those of us who have studied China, we know China as the export behemoth of the world. That's why the air stinks in terms of the air quality, by the way, because they are producing product for the world and they've got factories spewing out pollution. And one of the issues is turning that economy, and this is like turning a huge cruise ship from an export economy to a consumer-led economy, and they're doing it.
They are doing it, although now they're having to deal with all the same things that the U.S. deals with, which is consumer confidence. And when you have a trade war and everybody has access to headlines today over the internet, the consumer can get worried. And in the fourth quarter, the consumer in China was worried.
You've been a big investor in energy, I know that. Tell us where you see growth in the world. Where are your most important investments right now?
Yeah, the latest data coming out of the global oil industry, and particularly the forecasters for demand, is that demand is in fact increasing. And the reason why demand is increasing generally is the globe is still growing, and that puts a larger demand on overall energy usage. We still see a tremendous opportunity in natural gas around the world. It is the transition fuel of the future. And while we also see great growth opportunities in renewable fuels around the world, particularly wind and solar, natural gas will be the transition fuel for a long time. And so right now, with equities beaten down and capital actually not going into the traditional energy industry, we see some great value.
Are there values in retail, another area of your investment? What are you seeing on retail?
Well, in retail, we own a number of very successful retail players. And the key to great retail today is innovation, digital offense, and in fact doing it differently than it's been done historically. And so who can truly displace the traditional way retail was done? And those are the companies we've been investing in.
Are you waiting, sitting on cash for a bit now as you assess the performance of your portfolio now that you have already invested in, or are you poised to put new money to work? Or with these uncertainties, government shutdown included, would you be poised to sit on cash?
Yeah, so remember, Maria, when we are entrusted with capital, we have 5 and 6 years to invest it, so there's no pressure at all. And over the last 4 years, we set a goal to raise $100 billion. We'll finish it up this year in 2019. And that capital's ready to be invested. There's no pressure. And so in a year where we expect the economy to, in fact, define itself. And we're a little bit more favorable, I think, than it's fashionable to be.
You're bullish on the U.S. economy.
Yeah, well, the United States economy is in really good shape. Listen, it could change if we don't see some progress on trade with China and the government shutdown, because those have the real ability to turn people's optimism into pessimism. But the underpinnings for the U.S. economy are quite good. Now, as I said, the big challenge, of course, is markets are volatile. And so that creates buying opportunities for us when we see a company that we think we'd like to buy today, but it's a bit overvalued, and all of a sudden the opportunity presents itself.
Was there an impact so far of the government shutdown? Do you expect this government shutdown to have a real impact?
In the grand scheme of things, no. I do think that, again, we're blessed. We get to own companies for 4, 5, 6, 7 years, sometimes 10 years we can stay invested in a company. And so what happens over a 30-day period or a 60-day period, it really isn't going to impact the outcome. We do actually see all of the topics that were discussed earlier. So particularly in Washington, where I live, where a lot of these federal workers that are furloughed or working without pay live, we're seeing the economy impacted. But we're very hopeful that the pressure is building. We've got another pay cycle coming where these workers are going to miss another paycheck. And you can see the temperature turning up between the White House and Congress.
So is there any reason to believe this shutdown could end this week?
I don't believe it's going to end this week.
You don't.
But I'm here, and the latest I heard last week was they felt like they were not a week away.
Real quick, because this came up in the panel, I thought it was very interesting that Dr. Fang, who is the regulator who runs the financial services industry in China, said that the U.S. bond market has been a very good place to invest. Yeah. And they're not looking to lower their investment in U.S. bonds. But you've got to sort of question what China is going to do with all the securities it owns of the U.S.'s debt at a time when the U.S. has to continue selling more debt and that we're having this trade spat.
That's all true.
Do you worry about that?
That's all true. But first, just remember, you and I can invest in an overnight money market fund that will earn 2%. Or we can go buy the German 10-year Bundesbond for 30 basis points. So the Chinese government is smart. And that's a pretty easy trade, which is I'm going to put capital in dollars where I can get a return, or I can earn nothing in the next most liquid securities, which are euro-based. And so this is also driven a lot by just basic economics. Yeah. The returns in U.S. debt are more attractive than the returns other places.
Would you put more money in Europe right now, given the issues?
Well, we believe that Europe right now is really going through its toughest patch, and it has everything to do with confidence again. So two big factors. Big export economy. They're the leading exporter to a factor of 2 to 1 to the United States to emerging markets. And you have China's growth slowing.
India, Brazil.
Yeah, so it's not terribly surprising that Germany had a tough fourth quarter. Couple that with Brexit and the Italian issues, and the confidence in Europe has really slowed. We saw it in the GDP numbers. With that said, we're long-term bullish on Europe. The quality of the companies, the ability to grow companies outside Europe and expand them around the world, and the values that you can pay today in Europe are pretty attractive.
Glenn, it's great to have you on the program.
Great. Thanks for having me.
Thank you so much for joining us. Glenn Youngkin is the CEO, co-CEO of the Carlyle Group.